All right. Hello, everyone, and thank you all for joining us during the Lytham Partners Summer 2022 Investor Conference. My name is Robert Bloom, Managing Partner of Lytham Partners, and during this fireside chat, we welcome LB Foster, ticker symbol of FSTR, that's Foxtrot Sierra Tango Romeo, on the NASDAQ Stock Exchange. Today, we are joined by members of LB Foster's senior management to discuss the status of the industry and what the company is experiencing in the current environment. Today's guests are Mr. John Kasel, President, Chief Executive Officer, and Bill Thalman, the company's Chief Financial Officer. We'll dive into the discussion in just a moment, but I do want to remind everyone that LB Foster is available for one-on-one meetings today and later this week. If you've not already signed up, please send me an email at Bloom, B-L-U-M, at lythampartners.com. You can also visit the website at lythampartners.com/virtual. Click on the one-on-one meeting request button and we'll look to get you taken care of. As a reminder, today's discussion may include forward-looking statements and actual company results may differ. Please refer to the most recent 10K and 10Q for a full list of risk factors. So with that said, let's begin here. Gentlemen, maybe just a very brief introduction on yourselves and LB Foster here.
Thanks, Robert, and thanks everybody for joining us today. I'm John Kasel. I'm the President and CEO of LB Foster Company. I've been with the company. This is my 20th year, and I look forward to talking to all of you today.
Yeah, my name is Bill Thalman. I'm the CFO of LB Foster. I've been here with the company a little over a year and have been involved with a lot of the exciting things that we've been doing with the company in terms of the strategic reassessment. And it's been a very active initial year of the journey here at LB Foster. So looking forward to share a little bit more about that journey today.
So a little bit about LB Foster. So this is our 120th year. We're headquartered right here in Pittsburgh. We started up in 1902. It's a company that has a family tradition. In fact, our chairman of the board just stepped off. He hit the 75-year age limit here in May. But his grandfather and three other brothers started this business back in 1902. So it's transformed a lot. We started as a very small company serving the rail industry. And over the last number of years, since 2010, we've become a much larger, a global solutions provider of engineered manufactured products and services that really underpins. And what we're excited to talk to you about today is how we play into the infrastructure bill activity as well as here and abroad. Anything you'd like to add?
No, other than to say that it's a very diverse business in terms of the industries that we serve in the infrastructure space. We have some pretty unique elements of the portfolio that you'll see through the strategic assessment discussion that we're trying to emphasize certain elements of the portfolio going forward. And I think you're going to see that as a management team that we're going to be pretty proactive and aggressive to transform the business in the coming years. And we'll probably share a bit more about that here in the next few moments.
Well, let's start right there, guys. As you mentioned, the company just completed a strategic reassessment. It was highlighted in your 2021 Investor Day event. Let's talk a little bit about that first.
Yeah, thanks. So it's exciting. I came on board 20 years ago, and I worked all throughout the company on the commercial side and manufacturing operations side. My job prior to President CEO was Chief Operating Officer, and it was clear that my succession, which we like to do here in the company, is promote within and really build off those foundation that we created here with the people, process, and talent management, is about strategy. We're not going to get a lot of depth on this, and I'm sure some of you are new to the company. You'll see that we kind of moved maybe off our strategic focus 5-6 years ago, and we explored some areas that weren't necessarily part of who we are and where we've been for the last 120 years. So it was important to go back and really assess who we are, what markets we serve, and how we add value to our customer. So we engaged with a company outside of L.B. Foster called TRC Advisories back in April of last year. And it was a good wake-up call for us because it really reinforced what we kind of already knew, that we have a lot of value to give to our customers, and specifically in the rail space and the precast areas. But what we really didn't understand is how we leverage that and drive our economic return to our shareholders. And we developed a playbook from there. So we're really focused on growth, top line and bottom line. We're going to talk more about with you today about that. But that was a wonderful opportunity for us to get focused. Bill, as he mentioned, just came on board last March. It was exciting for him to come because he really got to understand the business. And then since last March, we've been laser focused, and with my appointment in July, laser focused on now making these things happen. So we're excited to give you a little deeper dive into what our playbook looks like today and how we're going to create value for our shareholders. Bill?
Yeah, so the key evaluation point that we introduced to the organization through the TRC engagement was looking at each individual business from an economic profit generation point of view and identifying platforms for growth where it was clear through that assessment where we had a more substantial right to win in those spaces because of our capabilities, coupled with the market headroom for growth that we could see playing out over the next several years. So we decided to make very strategic choices on certain portions of the portfolio that would become growth platforms as opposed to returns platforms. Returns platforms are an important part of the overall portfolio composition, but they're more meant to be cash generating elements of the portfolio that can help us fund the growth that we see in very specific components of the portfolios, principally rail technologies as well as precast concrete. So we feel like we have those things very well laid out. We've begun to execute elements of the portfolio shift that we've laid out, including the divestiture of our piling business that we completed in September of last year. That was the very first major step that we took, and there will be more to come in the coming years as we reposition the portfolio for that more accelerated growth profile.
I think you talked about in the past year inorganic growth being a part of the strategy. Maybe talk and expand a little bit upon what that vision is for M&A.
Yeah, thanks. First of all, we love organic growth because it's safe. It's something that we have a lot of programs with today. We have a lot of really interesting technologies that we're bringing in from our European operations, bringing them into North America. But where it makes sense, M&A gives you that catalyst of getting you into a market or adjacent space that we're just not there today. And it's going to be difficult for us to get there organically. And so we don't have all the capital or liquidity in the world, but we do have enough to do these tuck-in type M&A type things, specifically in the precast and the rail side. More rail in Western Europe we're looking at today, and then precast here in North America. That's what's going to give us a little more scale. It'll differentiate ourselves. We're going to be careful not to lever up, but I think it is the opportunity for us to really do some portfolio management. We talked about that playbook a little earlier. A big part of what we want to get done is managing that portfolio. And some of these acquisitions are important to make that happen. I think we'll get there to where we want to become without it. Just these acquisitions, I think will give us the ability to get there a little faster than we might try to do everything all organically. So maybe, Bill, you want to add more color? What you think about the sizing of them?
Yeah, and I guess that's all in the framework of the aspirational goals that we've put out there for what we want to be as a company in 2025. During the Investor Day session, we put out a goal of being a $600 million business. We're about $500 million today. But we think that $600 million revenue target out there is a reasonable target for us to be going for. Relative to what we see as the organic and inorganic opportunities in front of us. We're targeting growth overall of about $250 million in total. It's going to be a combination of organic and inorganic additions to the revenue stream. As John indicated, we've got a certain idea of what we think that breakdown is going to be, but as situations unfold and market opportunities present themselves, we're not so set on doing absolutely $1 amount versus another in either of those categories. We're looking for overall $250 million worth of growth on top of that $500 million base, and of course. We've got a number of implied divestiture activities that's in that math as well. And we did the piling divestiture back in 2021, and it was about a $70 million business. So it's about half of what we've targeted. And we're going to look at the balance of the portfolio as opportunities present themselves and find ways to reposition the overall balance of the business to be significant platforms for growth in the spaces where we know that we have that opportunity to differentiate ourselves with technology or brand or capabilities that others in the market don't have. So we're looking at a 21% gross profit goal for that 2025 timeframe, and we're also looking to be at least $50 million worth of EBITDA on that $600 million base by 2025. And it's going to take a combination of organic and inorganic growth to get there. And we think we have a pretty clear roadmap that'll lead the way.
So let's talk about the organic side now. So in addition to the potential M&A activity, you are expecting some tailwinds from the 2021 Infrastructure Investment and Jobs Act. What kind of opportunities do you anticipate from that?
Yeah. So first of all, when just close the thought of what Bill's talking about, when you're talking about 50 million at the 600 million sales, we've been there before. So this is not uncharted or new territory. We've done 50 million before even done. So we are going to get back there. And a lot of it is going to come from the tailwinds that we're getting through this organic stimulus money in the infrastructure bill. We were very excited when that bill passed. Bipartisan bill passed. But as it comes with many things, well, you have to have a little bit of patience because it's about the money. It's about where the engineering work's going to be. It's going to have a real nice play for us on our rail side, which is both on freight and transit. We'll see monies flowing through our businesses related to that. Our precast side, which is large in infrastructure today of our 3 facilities, utility pipe products, that'll be a significant play will flow through those operations. And then when it comes to bridges, everybody's familiar with what's going on at our bridge, our state of the bridges here in North America. So we have our own bridge business that will have tremendous uplift related to this activity. Many people ask us why we don't have the work today. Well, it's coming. The survey work, engineering work is coming. We may see a little bit of work this year as it relates to revenue, but the reality is what we're going to see this year is probably more related to sales activity, and the bulk of it will be in 2023 and beyond. Bill, anything you want to add?
The only other thing I'd add to that is we've talked about in the past the Great American Outdoors Act. Yeah. That's a good example of how these types of programs play out. That was an approved government funding program back in 2020. We started to realize order intake levels for that funding in 2021. And now we're starting to realize some strong growth in our precast business from that particular program. So it takes a year to 18 months before it starts to get realized once the funding program is approved. And that Great American Outdoors Act is a good example of that. And the only other thing I would also add just briefly is that we have some significant opportunity in our business over in the UK that's unique to what we do here at L.B. Foster. It's a contract services business. We've used the Crossrail project that was just recently complete or is recently being completed here over the next several quarters over in the UK and really established our team over there as a significant partner for the railroad industry and the transportation industry in the UK. And there's some significant projects that are coming up in that space as well. And those are similar government-funded programs that should create some tailwind for the business over in the UK.
All right. Let's transition a bit here. The broader macro environment and potential for a recession is certainly a key topic for many companies today. How are you thinking about the impact of a potential recession?
Yeah, obviously, we're watching that very closely as things unfold. But I'll tell you, being here for the 20th year now, some of our better years came when the markets did contract. Back in the financial crisis, 2009, 2010, our precast business with the shovel-ready stimulus projects, we had fantastic years, some of the best years. So, you know what? We'd hate to see it, Robert, but on the other hand, I think we're well positioned when these type of things and the tightening of the markets, the labor force will tighten, other things will start to tighten. But the reality is we're well suited, especially with the infrastructure bill laying over the top of this. Money still will be spent, and I think our company is probably as good a shape as any company going into possible recession type environment. Bill?
Yeah, no, I would agree with that. I think when you looked at the broader industries that we're serving and the opportunity for funding at the government level to continue to advance those projects, even in a recessionary environment, would allow us to continue to see an improvement in demand as those projects start to get funded and executed. One thing, obviously, is a bit of a topic for everybody at the moment is the labor market and the ability to get labor to actually execute on those projects might be a little bit of a challenge at the moment. But if you think about a recession that might potentially impact other industries other than those infrastructure related businesses, that might actually end up freeing up labor that otherwise would be used elsewhere to help advance those projects. So we never want to say that we're recession proof, but we like the position that we're in related to the government funding of the major programs that we see out in front of us.
You just touched a little bit about this with the labor market, but, maybe expanding beyond that, how is the company faring with today's inflationary environment and some of those sort of, supply chain disruptions we've seen out there?
Well, it shocked our world as it shocked everybody else, right? You couldn't get out there fast enough. And our company is really strong in OpEx, something that I've been working, I started the company with operational excellence. So our first mitigating action was to try to get our cost, manage our cost at the shops or yards or processes. But what we found is it wasn't enough. Prices were rising so fast that we had to go out there and get in front of it and really rise pricing, unlike we ever done before. And it got us to think different. And honestly, we're a much better company because of it. Well, much of what we did before is we would figure out what we'd like to make. We take our costs and put a margin on top of it. Well, maybe that's good for the 120 years, but it's not good in 2022. So we got into focusing on what market pricing is and what levers we need to pull to make these things happen and get out in front of this thing, unlike any time we ever did before. So we've had a little bit of a crisis, a little bit fire by management, or getting after these things and really testing our ability to stay in front of pricing. In some cases, though, we had some contracts that were limiting, and we follow, we live up to what we do with our customers and our contracts. So the good news is some of these have the opportunity now to negotiate and change. But the primary focus that Bill and I'll let him step in here, that we have this year and the years to come is about gross profit. It's about managing that gross profit line, the profitability of this company. So we'll give up some of that top line sales, but we're after the gross profit and really driving that throughout the whole investment community and back into our shareholders. Bill?
Yeah, I would say that that margin performance has been a very top of mind topic for our senior management team. When we reported our Q1 results, we saw a bit of a stabilization in our rail business overall. Rail margins were pretty flat year over year and actually up slightly from Q4 to Q1. But in our precast business and our steel products and measurement business, we saw a pretty significant headwind. And our precast business has been aggressive in terms of moving on pricing where they can. And our steel products and measurement business is starting to see pricing and margin performance stabilize at a level where we should expect to see some sequential improvement. Now, it's going to be a while before we start to see year-over-year improvements in overall margin performance, but we feel like Q1 was a period where things started to settle out, and we should expect to see an improving margin profile as the year progresses at this point. And so, in terms of things that we're doing to make sure that we can just manage through these inflationary timeframes, as well as ensure that we can continue to serve customers as needed. We're making sure that we have product available. We're carrying a bit more inventory just in case to ensure that we can supply our customers as they need it. And I think as we've reported in our Q1 results, we have a very robust backlog of business to serve. And so we're in the process of executing against that backlog and driving to start showing the year-over-year improvements in profitability and top line growth as the year progresses.
Let's stay on macro for one more topic here. When you sort of detail and look at this business, what are the sort of macro events that are positive indicators for L.B. Foster?
Well, first and foremost, the government spending is critical. And what's happening, we talk about infrastructure bill, but there's a lot of monies that are going to be let in to get this with the infrastructure where it's at today. I think that's macro number one, because that really gives the confidence that to not just us, but to the people we supply products with, that this is going to be an ongoing concern, and that we're going to be in good shape. And people will feel comfortable about stepping out in perhaps a recession environment and going forth with projects and programs, knowing that the government and the monies are going to be flowing through. I think that's very important. Oil, there's, obviously the price of petroleum and everything else is going, haywire today. And the good news for us is many of our customers rely on petroleum products. Specifically, our largest customers use diesel fuel. So that's good for us, because we have solutions that allow them to save on the usage of diesel fuel. And we're excited about them now really adapting. In the past, diesel fuel just went up $1, and that was not that big a deal. When it goes up $1, it's significant. And so now they're really embracing and really starting to pull on us to bring these technologies to them, where we could be possibly saving them 5 to 8% of their diesel fuel, which is by far the largest cost element that they have. The other piece that I think is exciting is, the environmental, the focus on environmental, what we're doing today within the company and what we're doing with our carbon footprint is huge. And it's also the same true with our suppliers and our customers. So I get excited about that, because we have the commercial and solution offerings to do a good job managing our own carbon footprint, as well as our customers to be able to impact and reduce their carbon footprint. So I think that's these outside macro things that many people are kind of watching and excited about or concerned about. I think we have a very large commercial offering with the company of what we can do to continue to grow value in the years to come. Bill?
Yeah, I think the only thing I'd add there is the energy business, where in the past it was maybe a much larger component of the overall business portfolio with the iOS business that we divested in 2020. It's a much smaller energy exposure, is a much smaller component of the business overall. We're projecting at the moment that it's kind of bouncing along the bottom, and we don't anticipate it getting worse than where it is at the moment. And we frankly think, given some of the renewed focus on energy independence here in the U.S. And some of the other projects out there like carbon capturing, could be some tailwinds to support that portion of the business here in the medium to longer term. But again, it's a smaller component of the portfolio today, and we're focusing our investment and our growth dollars in those two specific areas of precast concrete and rail technologies.
All right. So, and I only have a couple of minutes left here, but when you sort of think about the next couple of years, what are the technologies and or products, that you are most excited about right now?
Yeah, so I could go on much more than a couple of minutes on this, Rob. This is really where the rubber hits the road, and we get excited because this is the transformation of the company. For the first 100 years, the company's been really heavy in rail, but it's been on the product and commodity side, kind of the widget side, which is great. Don't get me wrong, but it really is not something that's transformational. It's not something that can really drive gross profit margins year over year. It's something that doesn't give you that double-digit growth that you're looking for. And we have a number of things that we've been working on now for the last 5 to 10 years. It's been really exciting. And it's specifically in two areas. Rail technologies, first and foremost, the innovation that's coming here in North America and out of our Western Europe operations, of giving our customers the ability, I mentioned earlier, to save fuel, to have their assets live longer, to be able to come to a train stop and make sure you stop, to give that customer the best ride they possibly can, to walk into a train station and give that customer the experience of knowing how to navigate their way to and from a train. If there's a disruption, or like happens every day here, it gives that customer the ability to get back on track where they need to go related to their passage or their journey. It's exciting with the company because we've had a hard time actually getting our customers up to speed on some of this disruptive technology innovation we have, because we've been so much of a different player for so many years. And that's where the company's really pivoting. And it's also giving us that much larger global footprint. Many of the things I'm talking about are transferable. They're much easier to move products and technologies and protected through IP and patents across the globe. And to me, that's probably the most exciting thing of really adding value to our customers, where they can run a railroad or transit authority much more efficiently and effectively, make sure people get where they need to safely, and where their returns are better each and every day. The concrete side is also something that we've only had now for like 22, 23 years. And that's really been a good business for us. We started with making restrooms for state and federal national parks, and we migrated in through M&A work. We're doing much more activity now related to utility products. And this is primarily a North America play, but it's exciting. It's really exciting because growth is everywhere right now. And building up the infrastructure or renewing infrastructure starts with foundation and infrastructure, and typically concrete products. So we're very excited about the opportunities we have related to that business here in North America. And we've built a great team here in the Pittsburgh corporate office that allows us to be able to go in and out of these markets with an engineering talent, with a good IT platform program, and a great sales, really customer-focused sales team here that is second to none. Bill?
Yeah, I guess I just wrapped that set of comments up with, when you're thinking about from a rail technologies point of view, we're all about improving the efficiency of the network as well as the operating ratios of the railroads. And our technologies can do that. And they are much more interested today than they have ever been because of the condition that they're in and what they have to do for their shareholders. So we feel like the growth opportunities are very well aligned with those needs. And we've got a precast business where we think that there's significant headroom for growth, both organically and inorganically. And so the future is bright in terms of us making those steps towards those aspirational goals that we want to achieve in 2025. And we're really excited about managing those short-term challenges, but with our eye on the future of driving towards those goals.
Perfect. Well, look, only maybe a minute left here. Any sort of closing comments, any takeaways that maybe we haven't hit on that you think it would be important for investors to understand?
Yeah, I would just say thanks for, first of all, joining us and interest in the company. And I think this is a great time, not just to learn about the company, but to invest in the company. I think we're sitting in a very good position right now. And there's a lot of upside potential of this company for years to come, and with an excellent return. So thanks for your interest, and hopefully you'll have an opportunity to do some one-on-ones with us. We'd love to take your questions and hopefully give you a better understanding of what we are and, more importantly, where we're heading. Thanks for your time again today.
Perfect. Sounds good. Well, John, Bill, thank you so much for that time. We greatly appreciate your time here. Again, as we said at the beginning, to anyone that is not already signed up for a one-on-one meeting, if you'd like to do so, send me an email, bloom@lythampartners.com, or again, visit the website, lythampartners.com/virtual. Click on the one-on-one meeting request button, and we will look to get you taken care of. So we hope you all enjoy the conference. John, Bill, thank you so much again.
Yep. Thanks, Robert.
Thanks.
Take care.